All right. Well, with that, I think we can get started. Okay, so I just want you to know that the passion and the way you talk about helping the students, and I know Joe, Shelley will have a passion for helping the youth, but also our communities. My background is in social work, so I get all excited when I hear all the stats and what you're doing for the community. So thank you so much for that. And just here, I think we were on a little bit before we started the recording, but I'm Edenice Danis. I'm with Key Private Bank, and I am currently at the Fort Myers office, but I bounce between the Naples and the Fort Myers office, mostly in Naples. And I have two colleagues here with me this time. Last time was just me, but we have two helpers this time. We have Joe. Joe, I'll let you introduce yourself, and you can pass the baton over to Shelley after that.
I'm Joe Pignatano. I'm one of the senior relationship managers here at Key Private Bank. I've been in the wealth management industry for just about 15 years. Grew up in New York City. Found my way down here as I had some family down here about 6 or 7 years ago. Been at Key Private Bank now for a little over a year, and work closely with Ed and Denise here in the local Naples office.
Oh, that's Shelley.
Hi there, I'm Shelley Eckert. I'm the Home Lending Center Manager for mortgage and home equity. I've been with Key for about 6 years now, in lending for about 20 years. I am in Cincinnati. I actually have a team that sits all over. I do have one person that's in Florida. I have some in New York, Ohio, and then some even on the West Coast. So pretty cool.
All right. Well, thank you guys for joining us. And Shelley's not feeling great, but thank you for for joining the call. All right, so we'll get right to it. So buying a home, it's a very exciting time, but it is also very intimidating, very stressful when you start thinking about it. So today we're gonna go through different things about what to think about when you're considering buying a home. We'll go through the costs and responsibilities associated with home ownership. We'll go through exploring the loan and repayment process and learning how to find out if you're financially ready to own a home. We'll go through pros and cons, and then we'll also go through some banking terms to help you navigate those as you're getting ready. And then we'll have Shelley talk about some great opportunities that Key Bank has right now to get people started if they're thinking about purchasing a home. All right, so first off, we have, this is a poll. So I want you to read through the four, I can read them, but I want you to tell me, and last time we used the chat option. Do we have that? I don't know where it is. Option. Maybe Maria, you can help me with or Joe. So which one of this, let's see, your home is an asset. You need to make payments towards a home. You need to pay taxes on a home, or you can remodel your home any way you like. Which ones are pro and which ones are cons of purchasing a home? I can't see that. I can't see. People are writing. You tell me. Oh, I see.
You got it up? Okay. I was gonna say, Maria
right.
was nice enough to chime in. She put her pros are your home is an asset and you can remodel your home any way you like. And a con, you need to make payments towards a home. You need to pay taxes on a home.
All right. Anyone else feels different about those? Okay. What happened to my page? Hang on. There we go. Okay, so you'll be surprised, but maybe not surprised, but ultimately, they are both. So if your home is an asset, so it is a pro, the value of your home may go up over time. So a lot of people, think of it as an investment, which it is. I'm going to buy a home and then someday I'll sell it and it'll be worth more than what I bought it for, right? So that could be a pro, but the con is that that's not always how the market goes, right? So sometimes the houses, you can get a lot more for them. Sometimes you have to put so much into the home that you might not get more of it, but it is definitely an asset. You need to make payments towards a home. So ultimately, buying a home is kind of like a forced savings way, right? So you have to make your payment towards a home. A portion of your monthly payment goes to the principal, and every month it gets you closer to owning that home. And the con is that you need to make down payments up front. You need to make payments, right? We don't like to make payments, but ultimately it is a forced savings plan, right? Because once you're done, you'll have an asset. You need to pay taxes on a home. So a pro, it's homeowners may be able to deduct property taxes on their income tax returns. Oh, Barbara, I heard you. I don't think I can put her on here. And you must pay property taxes is the con. We don't like to pay taxes either, but so your local government will use the taxes that you pay for services that they provide locally around your area. So that's good that we're paying the taxes. No, it is also, a con. You can remodel your home any way you like. So that means you are the boss. So if you want to paint, what color, Joe, would you want to paint your entire house? Bright pink, bright green, bright.
Either one. I'm more
Anyway.
neutral, so some sort of gray probably works for me.
Gray, yeah. So you can renovate and decorate your home any way you want. You are the boss. And the con is that you are the boss. So you won't be able to call the landlord and tell them to, the plumbing or you need a new AC or whatever it might be, right? So there's some additional repair and maintenance costs associated with it. Are there any other pros or cons that anyone can think of that maybe we didn't talk about?
No, but Joe might not be able to paint that home pink in a gated community.
That's true. You won't. I was thinking
You
of
have to
the
ask for approval.
inside, but gosh, sometimes you can't even put up make holes in the wall, right? To put anything up.
Right.
So
Mhm.
all right. All right, and make sure there's nothing else in the chat. Okay, so here's some common terms for banking. You've probably heard a lot of them. So we have 5 common terms. We have income, income history, debt to income ratio, credit score, and down payment. So the income is the money you earn, your salary. It's very important that when you're thinking of applying for a mortgage or really any other type of credit, you're thinking of not just your salary, but are there any tips, any social security, any investment income that you're receiving? It's very much needed and common now for people to have a side hustle or a side business, right? So making sure that you're gathering the income, how much money it is that you're making. And then the income history is the proof of that income that you're getting and how long you've been receiving that income. So the income and the income history, it helps to the mortgage lenders, the bank, understand if you will be able to afford that mortgage. Debt to income ratio is a percentage that measures how much of a person's monthly income before taxes goes towards their debt payment. So lenders prefer to loan money to people whose expenses are less than 43% of their monthly income. So maybe write that down, jot it down in the corner somewhere. So 43% is what they prefer. Obviously, the lower, the better. And Shelly, do we know exactly what, is there a percentage that KeyBank looks at? Do we have a black and white number? Or?
So they say 43. Sometimes you can get away with 45%. Sometimes you can get away with all the way up to 50%. So it just kind of depends on assets, credit score. As far as, when we're looking at income, we typically are looking for at least a 2-year history if it is employment income. Obviously, Social Security would be a little bit different, or if you have like rental income. But if it is, wages, we typically are looking for at least a 2-year history for employment. And then for credit score, you usually want to be above 620 credit score. Some companies on FHA may go as low as 580, but 620 is typically what most of the banks are using, is right around there. And as far as down payment, you can get away with 3% on conventional. Sometimes you can get away with 3.5% for FHA. And then we have a program that actually allows you to go up to 100% financing. So you could have as little as no down payment. You'd still have some closing costs associated with that, but you could get away with putting very little down.
Yeah. So we'll have you kind of go through those at the end, because we have a lot of promotions going on there that might be helpful either for you or for your family members or friends that you might know that are looking. So the debt to income. So we have some numbers maybe you want to write down. There's not a quiz. It's just stuff that I would write down if I'm thinking of my own, right? So 40, 43, 45, 50% debt to income ratio, credit score on 620. And down payment, it can be anywhere from 3.5 be the lowest, but we have other offers for that. Other terms is we have the 5 C's of credit. So those are capacity, capital, collateral, character, and conditions. The capacity is the ability that you have to be able to pay your bills now and in the future. So do any of you know how you could show capacity to pay your bills?
Having like a history of having done so.
Yeah. Your paycheck, right? Showing that you're receiving income, and then your history. Correct. All right. And then the capital is your assets. So any cash that you have, any savings, any investments, any property that if you needed to, you could sell pretty quickly for cash in case you're not able to pay up your loan. So the capital is your asset, but we're looking at them to make sure that it's something that you can sell and use for cash pretty quickly if you needed to. And the collateral is the property of the asset. In this case, it will be the mortgage that will be used to secure the loan. If it's an auto loan, it will be the auto loan, a boat loan, it will be the boat. So that will be the collateral for the secured loan. And the character is the history of delivering on commitment. So this is where you were talking about, Maria, to the history. Are you paying your bills on time? We can see that right through the credit score. And then if you're paying them on time, you're considered lower risk, right? So we see that it's something that you've been doing for a while, and we will feel pretty good about your character. And the conditions is the purpose of the loan and any factors that might impact the loan or affect your ability to repay. So on the conditions, I wrote down to what kind of loan you're applying for, or are you applying for an amount like I make I don't know, $30,000 a year, but I want that $1 million home, right? Like, is that actually, does that match with what I'm looking for? Joe might be looking at that Ferrari. Do we make enough money to get that Ferrari? This makes sense, right? Anything else, Shelly, on your end that when you're thinking, or that are things that you will look at as far as like the character of the client, or when you're reviewing their capacity, their capital, anything else that, or anything that you can share?
Yeah, so one thing I would add there, when looking at assets, the underwriter is going to look at bank statements, and they need to go back 60 days. So, it's really important that if you are looking to buy a house in the next few months, that you are depositing the funds into a bank account, and that we're able to source, where those deposits are coming from if they are large deposits. So typically a large deposit would be more than 50% of like your monthly income. So just keep that in mind. We do have situations where people have cash on hand and they just want to put it into an account. And unfortunately, there's no way for us to source where those funds came from. So, if you want to buy soon, open an account and start saving up so that we can, show the history to the underwriter. And then as far as collateral, one thing I would add there, it's important that the collateral is in good condition. If you're going to buy a property that needs a lot of work, there are certain types of loans for that, but it's not as easy as getting a property that is, ready to move in.
Right.
Shelley, you mentioned you need to present bank statements. Do they look at your spending habits, or is it just solely what money is coming into your bank account?
Maria, that's a good question. So they're not going to question if let's say you like to DoorDash all the time, right? But occasionally, if they do see a reoccurring payment that's happening, they may ask for, more documentation or an explanation on that to make sure that it's not a debt that's not reporting to the credit bureau. But for the most part, no, they're not, they're not going to say much about your buying transactions.
My mind went to, I thought you were going to say Amazon spending or something like that.
Well, yeah, I guess right now it could be Amazon. They're at my doorstep daily.
Yeah. Joe, anything on your end you want to add from what you've seen your years of experience?
No, I think you covered most of it, but by the way, it probably wouldn't be a Ferrari. I'm more simple than that. So it'd probably be a Porsche someday if I ever win the lottery.
Well, we had a budgeting class first, so even if you win the lottery, we got to go through a budget, Joe.
We'll do a financial plan for sure.
Yeah. And talking about that, so this right here, it might be very similar from our last presentation. We know that Christina, there's no way she lives in Florida, or I don't know where she lives, but her rent is $300 and auto insurance is $100. So don't worry about that. Just maybe add a couple zeros to it. But so the first step is to make sure that as we're getting ready to purchase a home, we want to make sure that you have an accurate picture of your current financial situation, right? We talked about that last time, how much money is coming in, how much money is coming out. But it's important. It doesn't matter how much money you have. It's important for you to have an accurate picture of your current financial situation and understand how it relates to the home that you want to buy. So right here we have Christina. She's a divorced mother of one. Her son Theodore is 10 years old. She has a full-time job, but she also works part-time on the weekend. She created a spending action plan to see what her current expenses are and how she spends her money. So she kind of wrote down the needs, which are the necessities, and then the wants, which are just the non-essential items. I want to move the cell phone back to the needs, but this is just a quick exercise for you to look at, just to remind you of how you can start jotting things down on what is a need, what is a want. Is there any place that we can look at that we might be able to start saving, putting money aside to either start paying off some debt so you can qualify for the mortgage you need, or just to start saving for a down payment? But we really need to get these numbers updated. It almost seems like a weekly expense here. Okay, any questions on this before I move on? Okay, so once we kind of have that clearer picture, we talked a little bit about the debt to income. We talked about most banks wanting 43%, KeyBank maybe being able to go up to 45, maybe a little bit higher. So I want to show you how you can figure out your debt to income. There are a lot of apps and things that you can use where you can track your credit score, you can track your debt to income, things like that. But what you're going to do here is we can just use SmartTest expenses as an example. So you are going to divide your total monthly debt, including your mortgage payments, by the total monthly income before your taxes and deductions. So we're not looking at the number of what's going into your account. We're actually giving you a little bit more room so you can use what your money, how much you make before taxes and any other deductions. So Martha's monthly expenses, she has a student loan payment. This is the minimum payment. It's not how much she owes on the loan, what you're gonna be looking at. The car payment, the minimum credit card payments, and the mortgage. So she has a total of $1,700 of expenses. And she makes $4,000 before taxes and deductions. So what you're gonna do is you're gonna divide the total monthly expenses, so the 1,700, by the total monthly income. And I'll let you pull out your phones. I feel like the teachers, you can use your phones now. I'll let you pull out your phones and do the calculations here. You're gonna multiply that. Well, it's multiplied by 100, but you can just divide it, and then you're gonna get the result, which will be the DTI. So I'll wait for you guys to do the math. And whoever wants to write it on the chat or yell it out. 43%. Did anyone else get anything else? I'm just kidding. It's 42.5, so we're rounding it up to 43%, which earlier we were talking about. That's kind of what we were ideally what we would want. And then that's how you can calculate your debt to income. So jot that down if you want that. At the very bottom here it shows. So you're gonna do the total monthly expenses. For the credit cards, you're gonna use the minimum credit card payment, even if you're paying more than that. And then you're going to divide it by your total monthly income before any taxes and deductions are taken out. Any questions on that?
And Denise, I would just add there for student loans, if you're in deferment, they will use 1% as the payment for that.
Oh, okay, good to know.
1% of the balance of the student loans.
1% of the balance of the student loan, okay.
Mm-hmm.
So would you be in deferment if you just graduated and usually you don't have to pay for the first 6 months? Or are you gonna just calculate
Correct.
the 1%?
Correct.
Okay. Okay.
And sometimes like we'll see teachers that are in deferment for a little bit longer too. They may have like a repayment program set up with their school after so long.
Yeah, I think social work educators, there was a time when they could defer too, so yeah.
Yeah.
Okay, thank you. All right, so we touched a little bit on, we touched on everything kind of here and there, but we just want to go a little bit deeper on the credit score. So the credit score is a magic number that whether you want a credit card, auto loan, a home, you know, that's kind of what determines if you're good with your money, right? How you're managing your money. So what affects your credit score is your payment history. If you're a day, 2 days late, that's not going to be reported on your credit. Not encouraging you to do that, but if you're 30 days, that's when it will go on your credit score. So if you figure out you're late, don't say, oh, I'll just wait until next month and do 2 payments or anything like that, because it's going to affect your credit score. So payment history, amounts that you owe, right? If you have credit cards and they're all maxed out, length of your credit history. If you're just turning 18, you might have no credit. So some banks offer secure credit cards so you can start building credit. That's credit cards that you put your own money and then just show that you're making payments to build your credit. But just note that it's very easy to drop your score, harder to bring it back up. So keep that in mind. And how do you check your credit score? Sometimes with the fee. There used to be a free annual report with the credit bureaus, but here's showing with the fee. You can pull up your credit report. Some credit cards offer kind of like give you an idea where your credit score is at. But the 2 credit bureaus that are mainly used are Equifax, Experian, and TransUnion. Some places use all 3, some might use just 1. And some things might be reported to 1, but not the other 2. So just keep an eye on it. Make sure that no one's using your credit and that you're using it wisely and paying things off. Usually the ranges go from 300 to 850. I don't know if I've seen it under 300. But that's not good. So just work on it, no shame. We'll just start paying things up. And then something you want to use less than 30% of your available credit on a monthly basis. So we talked about not maxing out your credit cards, but even if you have one or two that are maxed out, the other ones are not, you just gotta be under 30% of your credit usage. But do not max out your credit cards or any credits. That for the creditors looks like, oh, this person might run off and have to file bankruptcy here soon, or why are they applying everywhere? That's kind of those things kind of affect and makes the lenders look at things a little bit closer. Anything that anyone wants to add or questions on credit score?
I know during our last meeting, and I know we have a couple more of your team members on today. So one of the questions was, how do you build up your credit score? I know one of the things that they always tell you before you buy a home is like, don't take out, don't buy a new car, don't buy a bunch of new furniture. But how do you build up your credit score without also affecting your chances of getting approved to buy a home if you just haven't built up your credit score, period? I don't know if that makes sense.
Yeah, I did. I'll let Shelly, what are some things that you're looking at for people looking to specifically get a mortgage?
Yeah, so Maria, once you actually apply for to get pre-qualified or you start the mortgage process, it is really important that you then do not go out and buy like furniture and open up new credit cards, because we are monitoring, and the fear is, what if debt to income ratio then is not in line with where it needs to be. If you're doing those before you apply, like the savings secured is a great way to start to build credit. Then after about 6 months, maybe get a regular credit card. And then usually after about a year, you'll build up a score. Once you've built your credit up and you're ready to apply, that's when you want to be careful about applying for anything else. But if you are trying to build your credit, you do need to open a couple things up so that you have a history of credit, right? It goes back to having that history of payments so that we can see you made all your payments on time.
I would just add too, it's pretty simple and easy to freeze your credit as well through Equifax, Experian, and TransUnion.
Mhm.
So if you know that you're going to be applying for a home and you're worried, let's say you get an email or something that there's been a data breach at your doctor or wherever else, and you're worried your social security number is out there, definitely go on the Equifax, Experian, or TransUnion website. It takes 5 minutes to freeze your credit. When you go to apply for a mortgage through Shelly and her team or anywhere, they'll let you know so that you can unfreeze your credit for them to pull it. And once they're done doing that, you can go back and freeze it again, just to make sure that nobody opens another line of credit in your name, and then creates an issue for you in securing a mortgage or any other line of credit.
Yeah, so don't worry about applying at first, because you're going to need to apply in order to start building that credit. Again, some credit cards, secure credit cards, secure lines, secure savings. I know we used to have that at the key retail branches. We don't have retail offices here, but just as your local bank, and I'm sure they have, most have products to help build credit and get you started.
And then
They
just make
also
sure, like if you are using credit cards, try to pay them off monthly. That's always helpful too.
Yeah, that's a good habit to get into right away when you get your credit card. Harder to get out of the hole later. All right. Any other questions? Okay. All right. So we're just going to talk a little bit more about different costs that go into buying a home. So just because you're paying $2,000 a mortgage, rent right now, and your mortgage looks like it's going to be $2,000, does not mean that you're ready to go and you can go ahead and buy the home. We want to make sure, you might be, but we want to make sure that you know all the costs that are associated with it, and why it's important to kind of have a clear picture of what you're getting into before you approve. And the lenders, if they're good lenders, ethical lenders, they're gonna look at all that. We don't want to approve you for something that's just gonna get you to lose your home, you know, very quickly, right? We want to make sure that it's something that you can afford and you can enjoy. So we have the down payment, miscellaneous costs, and the closing costs. So we'll go through them. So the home buying costs, we talked about the down payment. We talked about anywhere, the lowest is about 3%, but it can go up to as much as 20%. Hang on, I'm trying to move all your beautiful faces so I can read. Okay. So a down payment is a cash payment towards the purchase of a home. It typically ranges from 3 and 20% of the purchase price. So down here we have a Marta, and Marta wants to buy a house that costs $80,000. See how having a down payment can affect her interest rate and other costs. So Marta does not have any cash saved for a down payment, but she was able to find a loan that will do it without a down payment. So she needs to borrow the full amount of the $80,000. Her interest rate is 5%, and at the end of the year, she will have paid $3,900 in interest. And the scenario B, Martha has saved $20,000 for a down payment. She needs to borrow only the $60,000 from the bank. So the down payment is $20,000. Her interest rate is 4.5. Because I don't know, because that's the rate for the $60,000 mortgage. But at the end, she'll be the first year she would have saved $2,700, which is a difference of $1,200. So again, you want to start saving money for a down payment. It's not always gonna be able to be that high. But any amount you can put down will help you save towards the interest. Let's just go into the next. Okay, then some other miscellaneous costs. We have the credit check. We have the inspection costs, appraisal costs, real estate taxes, repair costs, ongoing costs. Most of these costs, and Shelly, correct me if I'm wrong, it's been a long time since I signed a dotted line for a mortgage. All of this is usually added to your mortgage amount, right? Not the
Correct.
repair
So,
costs, but the inspection costs and the appraisal costs.
Yeah, those would be considered your closing costs, and then your real estate taxes would be what they consider prepaid items, real estate taxes and your homeowner's insurance.
Yeah.
So I did like a quick scenario for Naples, and it was around $8,000 in closing costs because of the, you have Florida mortgage tax as well. So when you start adding everything together, it does get a little expensive in Florida.
So 8,000, just generic closing costs, possibly. Is that what you're saying?
Yep, that would just be generic closing costs, and then you would have like your real estate taxes and your insurance on that.
In addition to that, yeah. So that's good. That's good to have that number in mind.
And can you include those closing costs in your mortgage?
You cannot include it in the mortgage. You would have to pay that either out of pocket. You can do some seller concessions, like if you want to ask the seller to help with the closing costs. And then I can get into a little more detail later if you can find a bank that either has grants or like we have a $5,000 credit that we will give towards closing costs as well.
So I know it's very intimidating, it's a lot, but we want to make sure that you know what you're getting into. But in the long run, right, it'll be like a forced savings for you and you will be able to own your home. So it's important to start working towards, knowing what comes in and goes out and trying to see how much you can put aside as far as savings. And then this is what we're talking about, just the closing costs. Any here is this anywhere from 2 to 5%, and we have a number for Naples around $8,000. So sometimes you can negotiate with the seller to see if they will take on some of that closing costs. And lastly, before we go into the offers and the different types of loans and more specific questions that you might have for Shelley, is the private mortgage insurance, also known as PMI. So that is an insurance that's placed on a mortgage when you cannot do a down payment of 20% or more. So if you the good thing is that once you owe 80% or less of the value of the home, that PMI, that private mortgage insurance, you can call to get it removed, or in some banks, it automatically falls off. So that's good news, but what that insurance covers, it does not cover you, it covers the bank. So if you default, if you cannot pay that mortgage, the bank is covered, but it does not cover you if you're getting behind or you start skipping payments. That's not what the PMI is for. There approximately ranges from $30 to $70 per month for each $100,000 that you borrow. And that's a monthly payment onto your loan. So another benefit, once you get to, you can pay extra anytime on your monthly payments on the mortgage to try to get down to that 20%. So you can get rid of that one payment and either use, if you're comfortable paying that additional $30, $70, maybe you can use that towards the principal and start tackling that that mortgage. Any questions on that?
And these, just to clarify,
Yes.
for anyone who's unsure, if they buy a house, or somebody buys a house for $100,000 with $10,000 down, that's a 10% down payment, right? If that house reassesses or is worth $220,000, in the next 2 years, that private mortgage insurance comes off because the value of the house has changed, not an additional $10,000 of payments, right?
Yeah. Yeah.
Okay.
So it's not just that you pay the 20%, but if the value of the home goes up and now you owe you're 80% or less of that you owe in the home, you're good.
Okay.
Yep. And you can, again, might have to request it for some banks, and some banks it just automatically falls off. Okay, so this is the exciting part. We have so many types of loans, and we'll try to keep it together, but the best person to explain this will be Shelley. Not only are there different types of loans that the government does, we have different things to offer people in our community, and I'll just let Shelley explain all of that for us. Thank you, Shelley.
Sure. So it starts off here talking about conventional loans too. So typically, if you hear anybody mention Fannie or Freddie, that's who offers the conventional loans. They have a couple of programs like Home Ready, Home Possible that allows you to get away with as little as 3% down. The rates are a little lower, and the PMI is a little lower on those programs. Then they just have their regular conventional, which is typically 5% down, or sometimes if you are a first-time home buyer with that one, you can also do 3%. So those programs are great. And then we also have FHA, which is government-backed. This is the one that requires you have at least 3.5% down. And then VA is typically for eligible veterans. It would require that you give us a certificate of eligibility, or a DD-214 is required. And on that one, you can go up to 100% financing. Sometimes there is a funding fee. In other situations, we'll look at the certificate of eligibility to see if you are waived from that funding fee. And then for USDA, we actually do not offer that, but that's just another type of loan that's typically offered in rural areas. I think more of the credit unions are getting into that now. Any questions on those three programs, or on the conventional Fannie or Freddie?
You see how quick we start using the banking lingo. She was mentioning the DTI and the PMI, so I'm going. That's why we went over them, because sometimes that's just how we talk.
Yeah. So PMI, for the most part, anytime you don't put 20% down, you'd be required to pay it, unless it's a specific program. Key has 100% financing with no PMI. Usually when you see no PMI, the rate might be a little bit higher since the bank is taking the risk of you not paying that PMI. Any questions on those? Let me know if I'm going too fast with these. And it does mention here financial institutions, credit unions, and then mortgage companies. So your financial institutions will be like Key Bank. Your mortgage companies are usually the brokers out there.
Do you want me to share what you sent me?
Oh, the flyers for
Can
the
you talk
Key
about that?
community
Yeah.
and the. So again, we have the 100% financing for our Key community loan. It is available in certain areas. We have a list of properties that do qualify that we can send out to you, along with the flyer for the Key community mortgage. And then on top of that, we also offer a $5,000 buyer credit that can be used towards closing costs and prepaids. With that, you could still ask the seller to do seller concessions up to the 4%. So technically, you could probably get away with very little down. So here's the flyer for the 5,000 home buyer credit that tells you can use it towards closing costs and then prepaid. So your prepaids again would be like your taxes and homeowners insurance.
So you mentioned some words, you mentioned concession and other things. Could you go through that again? Want to make sure that everyone
Yes.
understands what, yeah.
So seller concessions or the seller credit is basically the seller of the property would give you money towards the closing costs and your prepaids. Sometimes they'll do it as a percentage, like 4% or 3%, and sometimes they'll just do it as a dollar amount they want to give you. Maybe it's $2,000 or $3,000. And sometimes it'll say up to as well. It might say up to 4%. And the reason they will put in there up to is because when it comes to getting any type of credits, it can't go over the amount of your closing costs and prepaids. So the bank or the seller cannot be giving you money towards your down payment. It has to go towards closing costs or prepaids.
Okay.
And
So
then it
what would
tells
be
you
a
here it
reason
is
why
for-
someone would offer that? Is it because they want to sell the house? They just want to get rid of it? Or is there any specific reason why?
Yeah, so sometimes what will happen if we have a borrower that doesn't have a lot to put down, it would be a conversation we would have with their realtor to say, you know, they're going to need some help with the closing costs. So maybe they go in a couple thousand higher on the purchase price, and then they get a couple $1,000s to help them with the closing cost.
Okay.
I was gonna ask if any of you have some information that you could share. I know that, I think it was a law that changed across the nation. Typically, when you were going to buy a home, the seller paid the realtor that helped with the closing. And now I believe that's changed, and I think it's now on the buyer to pay those realtor fees. I don't know if any of you could speak a little bit more to that, because that would be something that a buyer would need to take into consideration.
Yeah, so now when you meet with a realtor, you are required to sign a buyer agreement. Honestly, I haven't seen anything different. It's still been the seller paying it for the most part on most contracts that I've seen since that went into effect. So were you going to add something to that as well?
Yeah, I was just gonna say, I think it's pretty much negotiable too, as far as I know too, right? And so when you sign that contract with the realtor, I think you can negotiate with the sellers before you enter into that agreement too.
Yeah,
Yeah, and most of the time it's just been business as usual as we've known it to be in the past.
yeah, I can share a personal experience. I actually had to talk it over with Joe, as his wife is a real estate agent. I'll put it out there. But I'm working with the realtor, and I was really worried about that because I didn't understand. So I had someone that wanted me to sign a contract for 3% for any home. So if I found a home, I was gonna have to pay her the 3%. if the seller was only willing to pay the 2%, I was gonna have to pay that extra 1%. So what happened with this specific home is she just did one contract for just that one place that we were gonna go see. And it was very last minute. And I had kind of done the work myself. So I found the place and I was like, hey, can you take me here to see it? So she just wrote down the 2%, which was what the seller was gonna be giving out anyway. So she's like, you won't have to pay me anything. You already did the work, so it'll just be the 2%. So it's definitely negotiable. And the person that was doing the 3%, she's like, I do a lot for my clients, so this is what I want. And if there's a difference, then you will have to pay the difference. And then this, so it just, you just gotta find a realtor that will work with you in that aspect. But
And is that an expense that you can roll into the loan? Or
No, you wouldn't be able to roll that into the loan.
Okay, it would be out of pocket.
If for some reason the buyer were paying it, that would be out of pocket. If the seller is paying it, typically it would just come out of the proceeds that they're getting back. And that's not, like when I mentioned seller concessions or seller credits, that's not considered part of them. That would be separate.
Yeah.
I'm watching, I think really doing their research on the realtor that they're going to work with. I know one of my friends just worked with a realtor, and she was not doing anything for them, and she expected them to pay, I think, the 3% down. So thankfully the house that they were working on didn't go through, so they found somebody else. But really important, I think, moving forward to know that you're working with someone that's looking out for your best interest.
And I would argue too,
I
right?
would-
Just because you sign a contract for them to represent you for that specific home or even another one, you can terminate that contract. It's not it's not set in stone once you sign that contract that they are the only real estate agent that you can work with going forward. So you have that flexibility.
Good point.
any other questions? Any concerns? Anything you're running into as you're researching purchasing a home, other than the prices are up? They're starting to go a little bit down. They're still really high.
I was gonna ask you, where did the Christina find that $80,000 home?
Oh, I know, right? I'll tell you these numbers. I'm just gonna make my own slides here.
So when I did closing costs, I did it based off 400,000 because I figured that was probably good for the area.
Yeah, that's a 1 bedroom or 2, maybe.
I was gonna ask if any of you have any tips or tricks. I know a lot of our alumni are probably first-time home buyers whose parents might have not gone through the experience of buying a home themselves. And so, like, for example, my parents ended up buying a Habitat for Humanity home, and that mortgage looks very different. And that experience is very different compared to what I had to go through, which was very stressful.
Yeah.
Not knowing or having someone to help navigate me through the experience. So I know, for example, one of the biggest tips that I've been given since buying my home has been to always, if I get a nice bonus during the year, to just put an extra straight mortgage payment straight to principal, and that should help you pay off the loan quicker. I don't know if there's any other tips or tricks that you would recommend.
Yeah, no, that's definitely great to do if you can make an extra mortgage payment per year. Some people will do biweekly payments. That used to be a big one. Some of the banks are handling that a little different, so you'd want to make sure whoever you have your mortgage through, if they allow you to do biweekly payments, but it's kind of similar to making that extra payment each year.
Round it up, right? Even if it's $1.
Yeah, round it up.
Anything counts and anything adds up. Yeah.
Yep. If you want to just add towards the principal each month, that's a great way as well. Denise is right.
Yeah. Makes it easier
And
for
do
me.
you probably have a pretty good rate. When did you buy?
About over the summer. So I
Okay.
think our rate is 5.9, something to that effect. And we did the FHA. So I was
Okay.
actually
Yeah.
about refinancing if we have maybe an alumni such as myself that already bought a home, like any words of wisdom if they were looking to refinance.
Yeah, so I would keep an eye on rates. Right now where you're at is a little bit below where the rates are. But if you see the rates drop, I would say, you said you're at 5.9. If you're getting closer to 5, especially if you're starting to get some equity to get out of the FHA and away from paying PMI, because I know the PMI on FHA is a little bit higher than typically conventional. And you can reach out to me anytime. I will send out my information. If you're just wondering if it makes sense, we can run a quick scenario for you.
Thank you.
Shelley,
And
what's
you
the
had mentioned before about calculators. If you ever go to key.com, there's different calculators on there, like how much can I afford? There's payment calculators. It's a great place to go and kind of play around. You'd go to key.com and then to the mortgage.
Shelley, what's the typical cost to refinance?
So it's going to be a little bit more expensive in Florida just because you always have to pay that mortgage tax. You probably would be looking around $4,500 to $5,000 with the mortgage tax, give or take. It would just depend on how much the mortgage tax was.
But that's added to the loan. Right, Shelley?
Yep, you could add that into the loan, correct, on a refi. As long as you had the equity in the house, we could add that in. And that's what most people will do. It's just add it into the refinance amount.
And I guess one last question for me is, so we talked a little bit about being smart about choosing the right realtor for you. What other, like the broker, I think is important. I bought a house, I should know, but I still feel like I'm so lost with a lot of the terminology. But who would be the top people that you would say you should do your research with if you're looking to buy a home?
I would say I would let Joe comment on the realtor part, but as far as when you're looking at a bank, you want to make sure you really have a good connection with the loan officer and that you feel like they're being very forward and investing in you. I think that's important, that they understand what you're trying to do and that they're really working with you to get you in the best program, and that they're working with your realtor as well to make sure that, you know, you, the realtor, and the loan officer know exactly what you're looking for.
Yeah, and I would say the same for your realtor too, right? Shop around, make sure you're getting somebody that's actually working for you. They're in communication with the seller, the things that you're requesting. You know, they're relaying over to the seller that they're able to do, you know, within reason, obviously. But you want someone that has your best interests at heart, because this is a huge transaction, right? And for a lot of people, it's a first-time transaction. So you want to make sure, number one, because of the cost, you want to keep your costs down, right? So if they're willing to negotiate that fee with you, you know, it doesn't sound like a lot, 1%, 2%, 3%, but when we're talking a few $100,000, that's a big difference. So, you know, is there a value add for someone that's consistently, you know, answering the phone, answering all your questions, and going to battle for you, that can negotiate a price lower? Absolutely. But just make sure that they have your best interest at heart. And like I said, if for some reason you feel it's not working out as expected, terminate the contract and find somebody that will do that for you.
Excellent. And Barbara, do you guys have any questions?
No, you guys did a great job covering all that. I wish I would have had somebody do that for me 45 years ago.
I know, it is nice.
We appreciate it.
I would just add in that to in the beginning of the year, there's usually quite a few grant programs. We do participate in hundreds of grant programs across the U.S. And if we don't, we can always try to get it approved as well. So it's not a bad idea to look into grants in the area as well.
Is there any particular location where you can find the resources for grants or other ways of funding?
If you go to like Collier County, you can find grant programs. Just like type in Collier County grant programs. I think I have a couple different links that I could send out to you along with our information, if that would be helpful.
Definitely.
Yeah, thank you. And I'll send it in the follow-up email to those that couldn't join us today as well.
Yeah, I'll send out the flyers that we have. I'll send out the properties we have that qualify for that 5,000, and then I'll also send out a link for a couple different programs in the area. They run out of money quick, so typically like beginning of the year is when they'll get funding. March, I feel like March, April is a good time of year when they usually have funding. I don't know, Joe, are you familiar?
I'm not sure, but
In
I can
Mayville,
look
Fort
it up.
Myers?
Yeah, I don't know. And then for the Keeper community, it's the one with no down payment. I know in the past you've been able to send us like a list of houses in the area that might qualify. Do you still have access to that?
Yep, I can send that out to you.
Okay, that'll be great too, just to give everyone an idea of what the areas and things like that might qualify. Awesome.
Absolutely.
Well, thank you everyone for your engagement, for your questions, for your input. Thank you, Shelley, for jumping on. Thank you, Joe, for getting on. And thank you, Maria and Bob, for having us. We really enjoy this, and I hope everyone took a lot of value out of it.
Thank you so much. It's really important for us to offer these kind of resources, so we appreciate you making the time after hours to meet with us.
Sounds good.
I'm glad Maria was able to videotape it so that she can share this with the rest of the alumni. It's very helpful. Thank you.
And we're always available to you if Joe, Shelley, or I, if you have any questions, okay?
Yeah, and Denise and I are local, so we're happy to help however we can too.
I now connect with you in regards to our next learning series, which should be taking place in 2 months.
Yeah.
Awesome.
Sounds good. All right, everyone. You have a good night.
Thank you.
Thank you all.
Good
Nice
night.
meeting you.
Yeah.
Bye.
Take care.
Bye.
Bye.